The cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years.
Media, retail investors, and some funds simply consider Chegg as a terrible company with an outdated business model being phased out because of AI. Or Chegg may be a cigar butt. Warren Buffett, in the initial clip, compares certain undervalued companies as disregarded cigar butts. Even though they may appear unattractive or near the end of their usefulness, they may still offer one last puff of value. So let's review what Chegg even is. Chegg Inc. is a California based education company and offers homework help, digital and physical textbook rentals, online tutoring, and other student services. Or to be more frank, students pay Chegg to unlock answers to their classwork through a subscription. Chegg used to be a Wall Street darling during COVID when education and most aspects of life went virtual. Virtual tools like Zoom video rocketed to the moon, and Chegg was part of the ride. From March 2020 to February 2021, Chegg rose 200%, or $39 to $113, investing in Zoom, Chegg, Etsy, hell, even Bath and Body Works made you a genius during COVID. Even SVB Financial Group was up 180%. Well, SVB Bank involved in tech that that sounds interesting. Maybe I'll buy some of that. Yeah. So maybe these stocks don't make you a genius after all. Etsy is down 83% since all-time highs, Zoom down 85%, Bath down 55%, and Chegg, oh boy, down 98%. Stimulus packages came rolling in, lockdowns were lifted, and people sort of forgot about COVID and returned back to their normal lives, and so did the stock prices. So here we are to the present day. ChatGPT, an AI model that allows you to ask nearly whatever you'd like, takes the world by storm, and Chegg stock continues downward. Chegg loses subscribers because students can easily ask ChatGPT questions for free on their default GPT model. Even though Chegg has textbook specific questions and answers, ChatGPT has digested so much data and different mediums of data like books and the internet that ChatGPT has most likely seen these textbook questions too. Chegg is now competing with a powerful AI model with immediate answers without having to pay a subscription for the default model. So Chegg is now at $1.72 as of recording. So what makes Chegg a potential cigar butt exactly? Well, let's start off with their revenue and profit. In the most recent quarter, Chegg generated 136 million in total revenues and 93 million in gross profit. Of course, the revenue and profit trends are facing downward, which is what investors are pricing in to continue towards zero. Let's also plot the stock price. Here we see that the stock price in 2023 at $20 a share, where the revenue was at 205 and the profit was 153. Now the stock is at $1.70 with 136 in revenue and 93 in profit. The revenue declined only 33%, profit declined 39%, while the stock dropped a whopping 93%. Sure, AI is taking over Chegg's business, and this fear is valid. However, this stock decline may be pricing in the worst case scenario for Chegg, bankruptcy. And this could present us with an asymmetric risk for potential upside. We can compare last September to the most recent quarter and see Chegg was generating less profit back then, but the stock price continues to decline with the negative sentiment and news. This is even more apparent when we zoom out to an annual basis. Chegg's revenue and profit from 2019 to 2023 has overall increased, albeit revenue started to slip and profits going flat in 2021. The stock price dropped from $100 a share to $1.70, when Chegg is still generating more in revenue and profit compared to 2020. We see Chegg is burning through their cash from 1 billion down to 361 million, causing constraint on their ability to pay down debt. Their total liabilities have declined, but not as the same pace as cash. The good news is that Chegg issued debt during 2019 and 2020 when interest rates were near zero, and they have increased their total debt repaid since then. Now let's take a look at free cash flow. Cash is king, and if something doesn't make money, then it doesn't make sense. Chegg still generates positive free cash flow. What's more interesting is that the stock was more expensive when Chegg only generated 96 million in free cash flow in 2019 compared to 2023 at 163 million. The annual free cash flow is up 68%, while the stock is down 98% since all-time highs. Instead of the positive free cash flow, the stock is exaggerated through market sentiment and hype during COVID, and then the virtual learning in COVID to an AI and increased competition environment in 2023. You know my favorite ratio, the price to free cash flow. This ratio enables us to see investors are willing to pay $1 for every X dollar in free cash flow the company generates. I compared similar education companies like Duolingo, Udemy, along with Zoom for the virtual factor. Here we see Chegg has the cheapest price to free cash flow ratio out of the group at 7.5. This means that investors are willing to pay a dollar for every $7.50 of free cash flow that Chegg generates. This current 750 ratio is below Chegg's historic average quarterly price to free cash flow of 23. For the annual ratio, Chegg is currently at 1.8, while the historic average is 40. If we assume the law of averages, Chegg's market cap could increase back toward the mean. Duolingo is the most expensive of the group at 254 price to free cash flow. Duolingo makes twice the amount of quarterly free cash flow. However, the price to free cash flow is 33 times more expensive compared to Chegg. Of course, an expensive ratio could be warranted. Duolingo is increasing their subscribers while Chegg is losing subscribers. Duolingo has an intuitive app that people love for language enthusiasts. Plus, the two companies are not exactly the same. However, these ratios across different companies showcase where investors are placing their money. This says Duolingo has a bright future while Chegg is going to zero, even though Chegg generates half the amount of free cash flow that Duolingo does. The market may be prematurely pricing in the end for Chegg when Chegg potentially has one or a couple good puffs left. Plus, a sidebar, I find it interesting that AI is the end for Chegg, however, not the end for Duolingo. Couldn't I ask ChatGPT to teach me Spanish and create a lesson plan for me? Chegg also created an AI model in partnership with OpenAI called Cheggmate to help students dynamically ask questions to a natural language model using GPT-4 and using Chegg's massive database of questions and answers. The stock market is pricing in the downfall of Chegg. However, Chegg still generates strong free cash flow. Yes, Chegg is losing subscribers, and if this trend continues, then cash flow could decline and burdens Chegg's ability to pay off its debts. However, this is currently priced in. If Chegg could prove stability in subscriber count or increase their language learning service, or just have one of these future earnings reports show positive results and catch investors off guard, we could see a pump in this stock. Chegg is a risky position, but a small gamble may be worth looking into. Chegg reminds me of GameStop. GameStop was threatened by online game downloads and online orders, just like how Chegg is now threatened by AI and other natural language models for faster and free responses to answer questions. Thank you for watching this video. What do you think about Chegg stock and AI? I would love to hear your thoughts down in the comments below. Thank you for watching, and I will see you guys in the next one.